For almost 20 years, one country dominated global commodities. Copper, oil, iron ore, coal, everything moved with one variable: China's construction and credit cycle. If China built, prices surged. If China slowed, prices collapsed. But today that world is gone. A new commodity order is rising, and most people haven't seen it yet. In this episode, we will explore why China is no longer controlling global commodities, which regions have quietly taken over, why structural shortages will define the next decade, and why 2026 could become the ignition point for a powerful commodity supercycle. This isn't a story about prices going up. It's a story about what the world will be forced to build next and what it will pay any price to secure. Let's begin. From the year 2000 to 2015, global commodities had one master: China. When China expanded construction, commodity prices soared. When China tightened credit, everything collapsed. That was the old model. But after 2015, that model broke. China hit multiple walls at the same time: a demographic decline, a property crisis that cannot be rebuilt, a manufacturing slowdown, rising local government debt, and tighter capital controls. China still matters, but it no longer decides global prices alone. China remains a massive consumer, but it no longer is the price setter at the margin. Instead of driving the cycle, China now amplifies shocks, and that opens the door to a completely new commodity landscape. For the first time in modern history, commodity demand is no longer coming from one giant economy. It's coming from multiple regions at the same time. Four new engines are now driving global demand. Let's start with India. India is in the middle of a massive infrastructure build-out. Manufacturing is expanding quickly, and consumption of copper, steel, and cement is rising every year. What's important is this: India's per capita copper use is still a fraction of China's, and that's exactly why India's demand curve matters. It's not about where India is today, it's about where it's heading. Next is ASEAN. Countries like Vietnam, Indonesia, and Thailand. This region has become a major electronics and logistics hub as global supply chains move away from concentration. Manufacturing exports from ASEAN have doubled in under a decade. And when manufacturing shifts, demand for aluminium, nickel, and petrochemicals show up first. Then we have the Middle East. Saudi Arabia's Vision 2030 and UAE's mega projects are not financial headlines. They are physical build-outs. We are talking about cities, transport, energy, and petrochemical capacity. Vision 2030 is not a slogan. It's one of the largest infrastructure programs in modern history. And finally, Africa. Africa's story is simple but very powerful. Population growth is rapid, infrastructure needs are enormous, and demand for steel, power, copper, and fertilizers is rising steadily. Africa adds population roughly the size of Europe every few decades. That makes infrastructure demand unavoidable. This is math, not opinion. So instead of one China driving the entire commodity cycle, the world now runs on four synchronized but independent engines. This changes everything. Demand becomes broader, the price floor rises structurally, and commodity cycles become more resilient and longer lasting. This is what a multipolar commodity world looks like. Another major shift is happening quietly. Countries no longer want to export raw materials cheaply. They want control. Indonesia banned nickel exports, forcing local processing. China restricted graphite exports, critical for EV batteries. Africa and Latin America demand higher royalties on cobalt, lithium, and copper. In simple terms, commodities are no longer just trade goods. They're tools of power. And the result? Fewer export flows, more price volatility, supply concentrated in fewer hands, geopolitics influencing availability. Many commodities are now strategic weapons, from nickel and copper to rare earths. Now we reach the core problem. For almost 10 years, the world underinvested in mining and energy. Why? Low commodity prices, ESG pressure, buybacks instead of exploration, fewer major discoveries, regulatory and political delays. At the same time, demand exploded from AI, EVs, solar and wind, data centers, grid upgrades, electrification everywhere. And the result: copper supply cliffs, silver deficits, uranium shortages, refining bottlenecks. This is why many call the 2020s the decade of shortages. Supply is tight, demand is shifting globally, geopolitics is weaponizing resources. So, what turns this pressure into a full supercycle? That's where funding mechanics come in. The world doesn't break when stock markets fall, it breaks when the US government struggles to borrow. That happens when treasury auctions weaken, demand falls, yields spike suddenly, foreign buyers step back, the dollar surges, global funding tightens. This is called a funding shock. The most likely window is around 2026, when several pressures converge. Record US deficits, declining foreign demand for treasuries, rising bond market volatility, China's local government debt stress, Japan's yen under pressure, synchronized global leverage. This is not a prediction. It's a mechanical outcome of too much debt and too little demand for long term bonds. When yields jump suddenly, global markets enter phase 1. Phase 1 is fast and violent. Long term yields surge. The dollar strengthens sharply. The yen weakens. Yuan weakens. Credit markets freeze. Equities fall. Bitcoin and the tech may correct. Silver temporarily lags gold. This is the panic phase. Everyone rushes to raise dollars. Liquidity disappears. But this phase is usually very short because the treasury market cannot be allowed to fail. That leads us to phase 2. When funding stress becomes systemic, central banks act together. The Fed injects liquidity, swap lines reopen, treasury buybacks begin, yield curve control is discussed, the Bank of Japan intervenes. China stabilizes its currency. The bleeding stops. But a massive wave of liquidity is created. This is the start of the next cycle. In phase 2, real yields fall, the dollar peaks, gold breaks out, silver outperforms gold. Copper, oil, uranium, and critical minerals surge. Commodities enter a multi-year structural boom. Liquidity does not return to old bubbles. It flows into the new multipolar commodity world where shortages meet demand. This is the ignition point of the new commodity order. As the monetary system fragments, commodities gain power. Nations that control oil, gas, copper, rare earths, uranium, and refining capacity gain strategic leverage. New alliances form around resources, example the BRICS Plus, Gulf Asia energy corridors, Africa India mineral partnerships, and gold returns as a reserve asset. Energy becomes a settlement tool. Critical minerals become bargaining chips. This is the backbone of the new global order. If this new commodity order is real, how do we know when ignition is close? Watch these 4 signals. Move index, which tracks the bond market volatility. When this spikes, stress is building. 10-year and 30-year yields. Rising yields signal weak demand for US debt. USD/JPY. A weakening yen signals funding stress. USD/CNH. A weakening yuan shows capital pressure in Asia. When all 4 rise together, the countdown window begins. After that, central bank action marks phase 2. We are witnessing the end of the old commodity world and the birth of a new one. A world where demand is distributed, supply is concentrated, shortages are structural, commodities shape geopolitics. The new commodity order isn't about getting rich fast. It's about understanding what the world cannot function without and positioning before scarcity becomes policy. You're watching MarketVelugu Light on Markets. If you find this video interesting, please like, share, and subscribe. See you in the next one.